Let's talk about August 15th, 2025. On that day, a single $100 million transaction completely rewired the power structure in Pan-African banking. Now, this wasn't just a simple trade. This was the endgame of a strategic campaign that was a decade in the making. Today, we're going to break down exactly how one of the sharpest minds on the continent used deep insider knowledge to take control of a massive, systemically important asset. So, $100 million. That's the number you see in the headlines. But honestly, it's a bit of a smokescreen. The real story here isn't the price that was paid, it's about the control that was acquired. This deal really answers two huge questions. Who is now setting the strategy for a bank with $28 billion in assets? And, maybe more importantly, why did a 17-year institutional partnership get unwound at such a massive discount? Right. What we're really witnessing here is a fundamental shift. For 17 years, you had this alliance between Ecobank and South Africa's Nedbank. Well, that's over. And what's taking its place is a totally new model. Control is moving away from what you could call passive, foreign institutional money, and it's shifting towards a highly active, insider-led African ownership. And that changes everything for the bank's governance and its long-term strategy. To really get this deal, you first have to understand the architect behind it, Alain Nkontchou. Look, he's not your typical commercial banker. This is a guy who came up as a global macro trader at places like JP Morgan and Credit Suisse. His entire career was built on one thing: spotting market dislocations and exploiting them, seeing deep value where everyone else just sees headline risk.
This timeline really maps it out. It's a decade-long campaign, and his background in global macro is so key here. He's trained to analyze sovereign risk, currency swings, capital flows, the whole 9 yards. He took that exact same toolkit and applied it to Ecobank. He joins the board in 2014, becomes the chairman in 2020, and all along he's viewing the bank not just as a lender, but as this complex, deeply undervalued proxy for the entire Pan-African economy.
Okay, so the whole logic of this deal, the absolute core of it, rests on one of the most powerful concepts in all of finance: information asymmetry. And Nkontchou didn't just have a slightly better analysis than the market. He had superior material knowledge that almost nobody else had. Think about it. His informational edge was absolute. As chairman of the board, he wasn't just watching the banks turn around from the sidelines, he was directing it. He knew down to the granular details about the balance sheet cleanup, the digital push under the GTR strategy, and all the operational efficiencies that the public markets just hadn't priced in yet. So Nkontchou's massive information advantage explains why he wanted in. But to really understand the opportunity, you have to look at the other side of the trade. You have to analyze the seller's exit. Why would a sophisticated institution like Nedbank sell a cornerstone stake in a major African bank for just $100 million? It just doesn't seem to add up at first glance. And the numbers here really quantify that strategic pivot. It's stark. Nedbank's initial investment back in 2008 was $500 million, $500 million. Their exit at $100 million represents an 80% loss in dollar terms. This was not a market-timed sale to take profits. This was the final painful step in unwinding a strategic alliance that just didn't work. So here you have these two completely opposite views of the exact same asset. For Nedbank, they saw risk without any real control. They were exposed to all the Nigerian currency volatility without having the power to actually dictate strategy. Their new corporate strategy was all about own and control, which made their passive Ecobank stake a non-core holding they needed to dump. Nkontchou saw the exact opposite. He saw a deeply undervalued asset trading at a huge discount to its book value, an asset that he knew firsthand was operationally solid and perfectly set up for a major re-rating by the market. Right, and this is the critical question for any investor looking at this. What was the tangible proof? What was the hard data behind Nkontchou's conviction that justified him writing a $100 million personal check? And the answer is right here in the operational results. You just have to look at the numbers. During his 4 years as chairman, from 2020 to 2024, Ecobank's profit for the year exploded from $88 million to nearly $500 million. This wasn't some speculative bet on a turnaround that might happen. It was an investment in a turnaround that he had already executed. He was basically capitalizing on his own work. So this acquisition does way more than just shuffle the names on the shareholder list. It fundamentally reconfigures the governance of the bank. It changes who calls the shots and what the strategic direction is going to be for years to come. The result is a really concentrated power structure at the top. After this deal, Nkontchou's investment vehicle and Qatar National Bank
together control over 41% of the entire bank. So this two-shareholder block can now effectively anchor the board and provide a level of strategic stability that, frankly, just wasn't there before.
Exactly. The whole dynamic shifts from passive to active ownership. And Nkontchou isn't just another big shareholder. He's now the strategic anchor for the CEO, Jeremy Kabori, and his growth, transformation, and returns strategy. His presence on the board, now as a super shareholder, de-risks all those long-term, expensive investments that the bank needs to make in its digital and tech transformation. So let's zoom out a bit. What are the broader implications here? Because this transaction is much more than just a story about Ecobank. You have to wonder if this could be a new playbook for how control of Africa's most strategic financial companies is acquired going forward. This deal really shines a spotlight on a key macro trend, which is the changing nature of capital in African finance. Foreign institutional capital, just like we saw with Nedbank, can be pretty flighty. When strategies don't align perfectly, they're out. This deal signals a potential shift towards committed, insider-led African capital, taking a long-term strategic view on these systemically important assets.
And you can actually deconstruct this whole thing into a repeatable 4-step playbook. Step 1, get deep insider knowledge, probably through a board seat. Step 2, use that position to create real, tangible value by overseeing a strategic turnaround. 3, be patient and wait for an institutional catalyst, like a forced seller. And 4, when the moment is right, strike with committed capital and buy that cornerstone stake at a discount. This is a blueprint we might see used again and again across the continent.
At the end of the day, for anyone analyzing Ecobank right now, the key takeaway is this. The market has just received the most powerful signal imaginable. The one person with perfect information on the bank's health and its future strategy just put $100 million of his own money on the line. I mean, that is the ultimate vote of confidence. So that leaves us with one final critical question. We've just analyzed how one person leveraged deep information in strategic patience to become a kingmaker in Pan-African finance. The real question now is whether this insider-led, control-oriented model is the future of ownership for Africa's most vital economic assets.